just going to keep it like this. And then, when our panel speaks, obviously that person will come up and you'll be able to see them speak. So this should be fine. My name is Jake Renfeld with Partner Engineering and Science. I'm moderating the owner user panel today. We've got a number of guests. We've got some bank lenders, some non-bank lenders. We've got a technology professional and an accountant here who are all going to talk about their particular trades and how it relates to owner user investment and in commercial real estate. So we're just going to do self-introductions here at first. You could, say who you're with and a brief little introduction to your platform or your products. And then I'll throw out some questions. We can make this interactive. Please feel free to join in at any time, including the audience. If you want to raise your hand or join in with any questions, I think we'd all welcome that as well. So first off, from Genesis Bank, we have Peter Yakub. Why don't you talk about yourself a little bit, Peter?
All right, thanks, Jay. I appreciate it. It's always wonderful to find ourselves back on Zoom after going in person. The universe is definitely toying with us these days, but we'll take it. So, but still nice to be comfortable here. Peter Yakub, Genesis Bank. We are primarily a commercial bank, and we focus on owner user multifamily investor real estate as well as SBA products. And we do have some secondary market options as well. We're a full service bank. We started back in August of 2021. So we are about to hit our 1-year benchmark. We've probably done about $200 million worth of real estate so far in the past 10 to 11 months. 100 of that was on balance sheet and 100 of it is off balance sheet, which is a little creative that we're able to do. So creativity. So if there's something that someone has a question about, what we're really good at is we are creative, and we get to understand the deal. We price fairly based on the risk of the deal, and we're not trying to get a higher spread. And we basically are building relationships. So if you're looking for a bank, you're struggling with the deal or need help, but you have a good borrower that has good assets and good cash flow. There's some hair, some weirdness on it. I can find a way to get that structured out. Rate wise, we are probably in the high 4s now, maybe inching at the 5, but depends on each borrower and what else they have. So once again, Genesis Bank, it's a pleasure to be here. I don't want to take up too much time. Would love to just have the interactive piece kick in and see if there's any specific questions. Thanks, Jay.
Great, thanks. Next up is Stephen Weiler. He's from a credit union. They're called Key Point Credit Union. Stephen, why don't you introduce yourself?
Thank you, Jay. Key Point Credit Union, Stephen Weiler. I do investment real estate loans nationwide. I'm here today to talk about owner users. I do owner users in the Western states. We are funding SBA 7A loans anywhere from $300,000 up to $5 million. And this might come across, even though we're in the heart of Silicon Valley, our program, I always tell people it's kind of like Little House on the Prairie. We keep it really simple. So you call me up, or you have your borrower call me up, they walk me through the deal, I listen, and I take really good notes, and I'll know if that deal is going to cross the finish line. So that's what I'm selling, is that certainty of execution. I have a 96.4% certainty of execution from when you originally send me the initial package. Right now, we have a surf shop in our pipeline. We have a concrete company. We have a convenience store. We have a liquor store. We have a bed and breakfast. We have a CPA. We have a diner here in the Bay Area, and we have a plastic surgeon down in LA, of course. And so we're funding these deals. They can be a partner buyout. They can be a change of ownership. We do investment. We do owner-occupied real estate in excess of 100% loan to value. As long as they're occupying 51% of the building, we can do the loan at 100%. We might do a 90% loan to value, but perhaps the business needs some money to relocate or for some working capital. So in essence, we are going above 100% loan to value on real estate. For this plastic surgeon, we're doing some equipment. Plastic surgeons need a lot of equipment. Hopefully I can get a big discount. That's why I don't have my photo up there today, or you don't see me. So the plastic surgeon, they're buying $1 million of equipment, and we're financing that. And then we do some large working capital loans. So Stephen Weiler, SBA lender, Key Point Credit Union. My cell phone number, you call me, I typically pick up. I pay rebates from 1 to 2% on every SBA loan. Thank you, Jay.
Thanks. Next up in our queue is Cliff Taylor. Cliff, tell us a little bit about yourself.
Hi, Cliff Taylor, Ready Capital. I'm with the Ready Capital SBA lending division. You're going to find out there's a few of us in here. We're a non-bank nationwide SBA direct lender. We are a direct and a preferred lender with SBA, even though we're not a bank. As a direct lender, non-bank, we haven't forgotten what side of the balance sheet makes money, so we're driven every day to make loans. We specialize in the SBA 7A program nationwide. Special use property doesn't scare us, neither do business opportunities. We'll do 7A loans up to 6 million plus, depending on the deal. We also do USDA B&I program on a nationwide basis. We pay referral fees. We do all the stuff all the other SBA lenders do, and we just do it a little bit more aggressively, and we execute it a little bit better. Anyway, Cliff Taylor, Ready Capital Lending. Thank you.
Thank you, Cliff. And I might get into what differentiates each of you a little bit later, but let's next go with Randy Jones at Spectrum Commercial Lending.
Jay, thank you very much. Randy Jones, Spectrum Commercial Lending. We're doing owner user financing, specializing in SBA 504 loans. We like that meaty B market. You know, that stuff that's a little bit more difficult to get done. You know, whether it's a debt coverage that's pretty tight, you know, credit and ethic challenges and things like that. We got a nationwide platform. Basically, we got two buckets of funds. One of them is secondary market. The other one is our own fund. With the latter being where we can do some pretty creative types of deals. We've always, like I said, we've always thought of ourselves as a 504 shop. We can do any type of owner user, whether it's conventional. Also, we can do those. But you know, we're basically doing mostly purchases. Although what's really starting to come on with us is the SBA 504 refinance program. So we can take hard money and SBA 7A loans and also do those. Randy Jones, Spectrum Commercial Lending.
Thank you, Randy.
Take it away.
Our last lender on the panel is Dane Court with Harvest. Dane, why don't you tell us a little bit about yourself?
Yeah, Harvest is a nationwide direct lender. We do SBA 7A, SBA 504, conventional. We'll look at investor. We'll do bridge loans. I do projection-based deals all day. You know, we go high leverage, projection-based deals. I go down to a 600 FICO score, blended. So, you know, husband and wife own a business. It's 50-50. Someone has a 680, the other person has a 590. We're going to blend those. We're pretty aggressive when it comes to commercial real estate. That's all we do. Owner user commercial real estate deals. We do investor stuff as well. But, you know, call me when the other banks are saying no, and we'll more than likely get it done.
Thanks, Dane. And then we've got a representative here that's trying to make all your lives easier through the implementation of technology. That is Chris Caragouin. Sorry about that. But I attempted it, Chris. Tell us about your technology and what you're doing for lenders and brokers.
Yeah, absolutely. Again, my name is Chris Caragouin. I'm CEO and co-founder of Help With My Loan. So guys, we're an innovative software company that automated the entire front-end lending process. Our AI's optical character recognition feature automated the front-end underwriting and loan matching. It does it at a proven 98% compared to the industry standard of funding loans, which is around 55%. We've given this platform access to brokers, bankers, lenders, and it's across commercial, residential, business, and consumer loans. We have vetted over 300 lenders to be in our database. So our AI is reading based on 300 lenders guidelines, and 98% of the time you are matched up the first time with the right bank and you process through much faster. And just to let you know from some quick numbers, we also have the platform that's funded well over about $450 million across those spectrum of lending I just mentioned. So yeah, looking forward to talking some more and making everyone's lives easier with our platform. Thank you, guys.
Thanks, Chris. And then last but certainly not least is David Flamer, our certified public accountant who's helped many owner users navigate some of the challenges with commercial real estate investment. Take it away, David.
Thank you, Jay. My name is David Flamer. I'm a certified public accountant with my own firm here in beautiful Agora Hills, working with a wide variety of clientele, but really truly specializing in all aspects of real estate, whether it's development, operation, any type of acquisitions or deemed sales, 1031 exchanges, and in all of that, trying to find the most tax advantaged method to operate that property. The owner user space has a lot of room for coming up with some really provocative and somewhat aggressive scenarios where owner user can get really truly maximal tax benefits while having the benefit of owning their own real estate and watching that investment grow. And so I look forward to assisting people in that vein and helping them get through the pitfalls and problems that sometimes present themselves. Sometimes there are, but if you can smooth it out, it makes for a great end result.
Thanks, David. And that's our panel. You know, when I think of owner user, you know, the first thing, and it's been mentioned on this call, is you know, my mind goes to kind of the SBA and these programs that are available that makes these, you know, these owner user investors, you know, really gives them a favorable rate and some other advantages to getting financing so they can own their own real estate. And then if I take that further, it's this question of, you know, 7A and 504. I know there's a few lenders on the panel that offer both. You know, if your client comes to you and they're not sure, you know, which program is best for them, you know, Peter, how do you approach that conversation? And maybe you could help the attendees understand, you know, some of the differences between 7A and 504 and how you take advantage of those two programs.
These days, lenders have gotten real creative with how they're using the 7A than historically we've seen the 7A get used. But primarily, usually you having a conversation with the borrower and you eloquently put it, these are the owner users a home for the business, just like you're buying a home. So that's why you do get the favorable rates. We do look at the operating company. So there are a couple of things. Usually down payment is a start. You can get away with, you know, usually 10 to 15% on a SBA product versus a conventional product, which is typically about 25% down. So sometimes there are businesses that just don't have the capital to do that, nor do they want to use the capital to buy real estate. They would rather invest it back in their company. And then on the 7A and on the 504, usually, and you know, there's a lot of SBA lenders on here, but typically if you need projections or, you know, they're buying a larger building to, you know, for fast growth, that's when you would see the SBA product come in a little bit more in play than a conventional product. So those are probably the biggest similarities is usually collateral could also be a play. So if there's a deficiency somewhere or someone just doesn't have the capital or nor do they want to put the capital, that's where the SBA product really comes in to add some benefits. But that's just a short version. I'm sure the SBA lenders could dive into it a little bit deeper, but there's a lot of layers and moving parts to each one, but it all really starts with the company and the amount of capital that they want to put in.
Yeah, thanks, Randy. You know, you specialize in 504 loans and you mentioned those B deals. You know, what is it about the 504 program that is attractive to your clients?
Well, yeah, Peter did mention a few of those, but the 504 is 90% over most circumstances, and it's a fixed rate. So it's two loans. It's going to be a first trust deed, and then the second trust deed is the same for everybody. It's right now it's about 5.2% fixed for 25 years. So, and then also it's qualified. With conventional loans, typically we need to do it for cash flow for 2 years. With the 504, it's for 1 year, and you know, we're able to you know, dip under our normal 1.25 debt coverage and get you know, as long as the you know, as long as the business is doing fairly well. So you know, I've had many a conversation with borrowers and they say, you know what, we don't like SBA loans. I go, okay, good, let's do it. Let's do a conventional. Let's talk about it. And during the middle or towards the end of the conversation, it comes back to the SBA, and they go, well, I mean, we only have to put down 10%. Why would we necessarily want to use our cash? So they're popular with just about everybody, and these loans go from, our loans go anywhere from $600,000 purchases up to maybe 10, 12 million. So that's I think that's why they're so popular.
Yeah, thank you. Dan, you mentioned you do both programs. It looks like maybe you guys specialize in 7A. How do you broach that conversation with your clients?
Yeah, I mean, it's really a timing factor. I feel an SBA 504 loan, which we do, it's a superior product. Like Randy said, you're going to get a fixed rate component. So, 7A loan is usually when the client has to close quickly. We're going to underwrite a 7A loan in-house. We're going to make a determination in-house for the most part and close. The difference between the two usually is, timing. If someone comes to me and needs to close within 30 days, we can look at a 7A loan. Sometimes they don't have additional collateral or they don't want to pledge additional collateral. So when you go above 85% on a 7A loan, we're going to tag additional collateral or look for some sort of additional collateral. Yeah. On an SBA 504 loan, generally don't have additional collateral pledge. So, with a 504 loan, we underwrite it, a CDC underwrites it, and the government's going to underwrite it. So you're going to add some timing usually to that process. Some people say, well, I want to go the 504 loan, and then if that doesn't work out, I want to come back and do a 7A loan. Doesn't work that way. If the SBA says no, you can't go back and do a 7A loan after they said no. You got to wait a period of time to, reapply on that. So those are sort of the differences on it. Sometimes if you get a small loan, below 500,000, a lot of CDCs don't want to participate in something like that. So, we'll look at a 7A loan and, close with that. But those are really the big differences between the two products.
I imagine from an owner's user standpoint, when they're starting to shop this and try to figure it out, it can be pretty challenging, right? A lot of different platforms, inconsistencies amongst different banks and lenders. Stephen Weiler, you're at a credit union. Talk about some of the advantages that a credit union might have over a bank lender or a non-bank lender. How do you talk to your clients about those advantages?
Thanks, Jay. Similar to what Randy Jones and Dane just said. Imagine that, quoting Randy and Dane, brilliant guys. Similar when we sit down with the borrower, we let them know the SBA loan allows them to keep the cash on their balance sheet so they can come up with minimal down payment, 10% down or more. And so, we explain to them the difference between the two. We can walk them, we give them the features and benefits of both the standard conventional loan with 25% down. They're going to have a little bit lower interest rate versus the SBA loan. We, by the way, also SBA loans, we have fixed rates and we have variable rates. So it's important to note that. So the SBA loans can be a little bit more expensive, but we can actually add that into the loan proceeds. So I'm sorry, Jay, did I answer your question? I want to make sure I didn't get off on a side track too much.
No, that's fine. I mean, the main impetus was my question was that if I'm coming as a small business, geez, do I go with a big bank? Do I go with a community bank? All these non-traditional lenders, people have these SBA programs. Is there a competitive advantage to going to a credit union?
Sure. So the big banks are amazing. We all have our credit boxes. So events like this it's one of my best referral sources. There's a deal there, there are deals that I just can't do. Like I don't do gas stations and I know who to call in the gas stations. I know several of the folks on this conference call. If I can't do a gas station, hey, I'll tell them to call this person or that person. So we all have our niches of what we can or can't do, and just being connected and largely, this is, basic, it's colossal redundancy, but it's just when you call a credit union, normally we pick up the phone. I don't even have my office line isn't even on my emails anymore. You call me and we pick up the phone. I listen to what you're looking to do, either for you or for your borrower, and I'll know if it's going to cross the finish line. And it goes back to that 96.4%, certainty of execution, where, the other financial institutions are amazing, but, just being small and nimble can be a real key competitive advantage.
Thanks for that, Stephen. Speaking of referrals, that tees Chris up pretty nicely here. Chris, why don't you share more about your program and how you might help brokers or lenders find the right programs for their clients?
Yeah, definitely. We have two platforms, right? So we have our broker platform. We also have our lending banking platform. So for brokers, the biggest thing that we're helping do is cutting that analysis time by 80%. So one, when you get a client, you're simply putting all that data right into our platform, which is, the personal financial statements, the different sets of tax returns, schedules, pay stubs. And within minutes, not days, not weeks, right? You're getting to know which banks from, let's say, a commercial real estate, you want to do an SBA owner occupied, you submit that scenario, our AI reads the financials, it tells you, hey, from the 300 banks, here are the top 8 right now. And that speeds up a lot of time, right? And just also with that, we're use nothing but our top reps, top producers at these banks. So when you're getting the rep sent the financial package from our AI, you're moving things much faster because you're also getting one of the top reps from the banks. Now, on the caveat to the lender platform, it's also helping when it comes to that is to kind of get up that process much faster. You want to be able to sometimes say that quick no, because if the cash flow is not working, this isn't working. Again, you don't want to spend weeks or days. The other thing we do help is how many entities you can do. A lot of these complex deals are sometimes 15, 20, 30 different entities with different tax returns. For every year, our AI can read up to 56 tax returns and sets of financials, which is huge. And I mean, how fast that means? It reads millions of lines of tax code within seconds. We update our tax codes every year as obviously administrations change and different things happen. So basically you're getting fast decisions on your clients. The other thing I'll add is you're also able to sell new products, right? If you're doing commercial real estate as a broker all the time, well, 9 out of 10 times, if it's a business there, you're now able to also offer with our product business loans. So you don't always have to use that property. We have lenders that do unsecured lines of credit, unsecured term loans that are not always, the big banks or credit unions. They're also smaller direct lenders, they're online banks. So it's also helping banks and brokers cross-sell new products that they were not offering before. So that's kind of how we help a lot of brokers and banks just do a lot more than just lending. It's also cross-selling different products that you were not doing before.
All right, thank you for that, Chris. You referenced tax returns, and we haven't heard from David. David, there's an owner user, all of a sudden they own real estate. Certainly there's some tax implications and some accounting they're not used to having to address. What kind of tax issues should an owner user expect when they decide to purchase their building?
Well, a lot does revolve around, being able to perhaps have that newly acquired property in a separate entity. And especially if that owner user has a profitable ongoing business, it's a tremendous way to shelter some cash flow out of that business. That said, we have to come up with the appropriate ways to get that done. And so what we'll try to do is make sure that we're maximizing depreciation, making sure that we have the best information possible with regard to speeding up depreciation. Perhaps a cost segregation study might want to be put in place. Not always necessary, but usually quite helpful. We want to make sure we know what market rents are, so that we have an idea of what that business owner can pull out. A lot of people think, well, I can just charge whatever rent to myself I can. That's not necessarily true, because it leads into a lot of other issues. And ultimately, we want to try to help our clientele make those right decisions that get them some benefits without more or less hanging them out to dry. I think one of the biggest issues that's out there is that excess rent situation and how it impacts real estate operations generally. It's important to note, and this is key. A lot of people think that, wow, I've got a loser piece of property that may be an apartment building that gives me a tax loss. I got my own building. I can create a taxable income to offset that loss. It does not work that way in an owner user setting. Okay, An owner user property is not a passive activity, does not generate passive activity income if it's coming through a flow through entity. So some pitfalls here and there to concern ourselves with. And that's where we come in, because what we're going to do is we're going to identify where all the benefits are and try to help a client steer clear of the negative issues and perceptions that arise. Also up front, it's abundantly clear. Chris, you're talking about basically your system. It sounds like just digesting tax data to assist, in coming up with that underwriting function. For us, it's all about making sure that somebody who's going to get into an owner user situation has the right information, has the right financial statements, is up to date with tax returns, doesn't operate an entity that for some reasons is in suspension because of something silly 4 years ago. Things like that. Try to help get the best situation before the transaction, and just try to make it that much better on the back end.
Hey, you referenced a lot there. If someone said, hey, what's the one major pitfall that I need to avoid? Is there something that really stands out amongst everything that you're referencing here?
I think it's charging / paying too much rent. I think you have to have a very good idea what the tolerances are in terms of the highs and lows, and always knowing what those numbers are, so that the amount in rent that is paid to that owner user property is within the market. But also a lot of people think, hell, I'll just go ahead and pay myself an obscene amount of rent and not pay myself any compensation out of that business that I have. In most situations, you really can't do that. And that's a huge, red flag, as it were. I'm not afraid of red flags, but if it's the kind of thing that we can avoid, it's kind of nice to be able to do that. Remember, if you got an S corporation, you got to be paying yourself compensation. If you're not, that's a huge issue.
Thanks. Open it up to questions from anyone. I figured I'd take this time to see if there's any questions from any of the panelists. We've heard from everyone to some degree. So I'll give a moment for some of the attendees. And if not, then I will continue to ask questions.
Hey, Jay, I don't think I got a chance to follow up here. So
No. I mean, I'm still going. I just wanted to take like a midway break here just to see if there's any questions, to help kind of spur some additional dialogue here. But I don't see any. So Cliff, you're a non-bank lender. We talked about some of the inconsistencies with platforms. I mean, there's a lot of advantages and disadvantages to various programs out there for an owner user. Tell us how you help your clients kind of navigate these different platforms, and maybe why you're a good home for certain deals.
Well, we specialize in the SBA 7A program at Ready Capital. We do not do the 504. So I really don't want anybody to start getting the feeling that the SBA 7A program is the redheaded stepchild of SBA programs out there. It is what is nice, excuse me, it is true that most 7A loans are done on a prime plus variable basis. The 504 does have fixed rate. What is nice is, except for the ability to refinance 7A loans, you can do anything with a 7A loan you can do with a 504 plus a lot more. We're able to not only finance real estate, but many times you'll have a business that includes real estate. We can finance that business as long as the real estate's more than 51% of the transaction. We can finance that business right along with it for 25 years. We can also just do business only type transactions. The business only transactions, anything under 15-year amortization doesn't carry a prepayment penalty. Anything over 15-year amortization, it's only got a 3-year prepayment penalty. So it actually makes a great bridge for folks. Sometimes the qualification's a little bit easier with the 7A, and we can use it for a lot of different things. So you can get in there and maybe do, I'll give you an example. I had a customer not long ago, well, it was 3 years ago because he's out of the prepayment penalty period. He already owned his business and was buying a property to move his business into. But because he already owned his business, I'm sorry though, there's some crosstalk there. Because he already owned the business, the 10% down, the down payment requirement with SBA for a 7A loan only applies if you're purchasing a business. Since he already owned his business, we did 100% financing for him to buy his building, plus working capital to go ahead and do the move. So we did about 120, 130% loan to value deal. That doesn't matter to us because we do unsecured deals all day long. And when you're over 85% with a 7A loan, yeah, you got to take additional collateral if it's there, but if it's not there, it's not a reason to not do the loan. So here we are a few years later, his value of his property has went up and he's going to refinance this and get into a nice fixed rate commercial type loan. It's a great long-term, long-term bridge to move into different types of property, get into your own property, buy a property like a gas station, C-store, a hotel that's appraised on a going concern basis that includes blue sky and business value, because again, we look at those values, we feel they're real, and we are repayment driven as opposed to loan to value driven.
Yeah, I think flexibility is an advantage for a lot of lenders working under this SBA platform. When is it? This is just to the group. Maybe talk about some of the disadvantages when SBA isn't the right choice for your clients, and tell me what you advise and what products you might have if they don't fit the box for an SBA loan.
Well, usually when someone doesn't fit the box, it's because of eligibility. It's either they don't occupy enough square footage of the property, and usually we can get creative on that, or it's not an eligible business. It's a nonprofit. As long as it's a for-profit business that's legal and moral, it's going to be eligible for SBA. But again, it's got to be active income. We can't do apartments. You might have again, it might be property driven. In that case, we're going to look at some, like somebody had mentioned earlier, we're going to look at our lender friends and say, hey, who's a good fit for this person to take care of them? Because at the end of the day, that's what we're going to try to do. That's what I'm going to try to do is help my customers get financing, whether it's me or someone else.
Yeah, Jay, one more thing too is the borrower may want to put down 25, 35, maybe even 40% due to exchanges, or they're just flushing cash. Doesn't happen a lot, but exchanges are they are pretty common. So that would be one example.
Yeah, disadvantage also for clients sometimes when you start looking at SBA, not a big disadvantage because of the capital, is sometimes the fees. Like Randy's example, if someone has the down payment and can go conventionally, the numbers kind of all match up and they don't really need to go SBA for projection or anything like that. The fees are sometimes a big deterrent because you're paying for the risk based on how much capital you're putting in from a leverage standpoint and anything that is projected as well. So that sometimes could be a disadvantage, but usually it does fit.
Do the collateral requirements turn people off sometimes, Peter?
Yeah, on the 7A product, yeah, that could be a deterrent. A lot of clients flip-flop during the process when you're doing the loan. I get clients that start out with a 7A loan and then they realize, well, I don't want to do that, and then they flip back or go conventional. They go the other way when they realize some of the requirements. But yeah, there are some. That's why you try to have that conversation early, make them aware, and take them down the road.
Great. Any questions from the audience for these panelists? I think this is supposed to be wrapping at 2:30, or are we going to 3? Does anybody know? I'm not sure.
I don't know.
Okay. Well, look, I got a selfish question, right? It's going to become pretty obvious while I'm asking it, but the SBA obviously has a lot of requirements and they're very prescriptive, and that's true for third environmental due diligence, right? So depending on the NAICS code, there's a tiered approach to due diligence. There are prescriptive requirements when it comes to certain environmental risk management issues, where they're quite clear on what the expectation is in certain issues. How do you prep your clients for environmental due diligence and navigating any potential environmental issues? That just goes out to whoever wants to take that on.
Jack, I'm comfortable jumping in on this. So it's Stephen Weiler with Key Point Credit Union, and yes, we have a license with the SBA, and we use it, and we're pretty aggressive about it when it comes to environmental issues. I know, Jay, you weren't looking for any props here, but I have to give them to you. So we use Jay and his team all the time. There is a heightened sense of awareness on SBA loans from an environmental perspective, and just making sure that your documents and just in general SBA loans have a lot more documentation involved with them, and just making sure all your ducks are in a row for that, and just making sure you're in compliance on these SBA files. We kind of sell it to the borrowers. They do growl at us when they find out that they have to pay for a phase 1 or a phase 2, and those cost real money, and we kind of couch it to them. That's the bet. Let's say it's $3,000. That's the best $3,000 you can spend on a phase 1 to not buy the property, because if something comes back and it's contaminated, and some of our borrowers on SBA loans, the properties can be more workhorse of properties where it might be in an industrial park. Our property might be clean, but the property across the street or up gradient might actually have something that's impacting our property. Borrowers growl because they want to buy the property. They're so emotionally attached to it, and they can see their business there. And again, we just indicate to them, it's the best thing for you not to buy this property based on here. We'll give them the report. Here is the report to walk away from the property. It does happen. We do get a lot of phase. Jay will complete a phase 2 for us as well with partners. And sometimes we'll get a clean phase 2, and then everybody moves forward and proceeds accordingly. So just, we're a PLP lender as a small credit union, but we're very robust in this, and just on an SBA loan, making sure all your I's are dotted and your T's are crossed. Our SBA files get audited on a regular basis. And I like that David Flamer touched on this, having the proper person do your books. Sometimes on an SBA loan, we didn't really touch on this, Jay, just for a minute. Our SBA borrowers oftentimes will have their sister Margie as their bookkeeper, and that's great. Your sister Margie is probably a good keeper. She probably did well in accounting, but get somebody that, and that's great for your standard bookkeeping. But when you're doing your taxes, and things like that, get somebody like David Flamer, get somebody who knows what they're talking about, because on an SBA loan, it's all about the documentation. We need balance sheets that balance, and we need reconciliation of numbers, and aligning yourself with somebody who knows what they're doing is just wise for an SBA loan. Does that make sense?
Yeah, thank you.
Hey, Jay, I got one for you since you're moderating, since you're on the spotlight. We over the last couple of years, 2-3 years, environmental has been a big issue that's been coming up a lot more, and with all the historical usage of properties that we've seen. Any recommendations that prep work that we can do when we know certain areas, mainly Southern California? I mean, you can probably talk about other areas as well, but primarily, you see dry cleaners and you see these, manufacturers of hazardous material, but there's no history there. Can you talk about that a little bit? Because I've seen that come up quite a bit and requires, next level of due diligence. Maybe just some feedback on that, and why that is. Maybe help guide some people when they're running into a deal.
Yeah, I mean, obviously retail, you would think is a pretty benign use, right? But what we'd all found out is that dry cleaners, and the SBA in particular, really moved the needle on risk tolerance for dry cleaners, right? So at one stage we said, oh, this dry cleaner, they've only been operating for 5 or 6 years, right? So short duration, you're not drinking the water, maybe it's not a problem, right? And then the SBA came out and said, this is what I'm talking about these prescriptive approaches. And they also have prescriptive approaches for gasoline stations, but they've come out and said, look, any dry cleaner is an automatic phase two, right? And what happened when the SBA did that? Overall, the lending community sort of came in line. And so even a traditional bank that's not doing SBA deals is saying, wow, they're requiring that. You know, we're gonna adopt a similar risk tolerance, right? So and it really comes down to this potential for vapor intrusion. And so why that's such a bigger issue and why you're seeing more deals go to a phase two is because, you know, before we weren't so concerned about the neighbor, the fact that maybe the retail center next door or the industrial manufacturing next door that uses these chlorinated solvents impacted the groundwater. You know, there was a time where we'd say, look, you've never stored these solvents. You're not going to be a contributor. You're not drinking the water. Now there's a much more focus on soil gas and the potential for vapor intrusion. And so if we can't rule that out in a phase one, and again, the SBA has very prescriptive requirements for offsite releases that are impacting your property. Subpart G of the SBA SOP, maybe it's referred to something now in their latest SOP, but you have to prove a number of different things about this offsite release to show the SBA why there's not a vapor intrusion concern and why you wouldn't be considered a responsible party. That's probably where we get the most screen outs are where we see the most screen outs are when the consultant doesn't specifically reference that SOP language and really hit a home run and or, you know, create a layup for the SBA risk managers to check those boxes on those offsite issues. And so just by nature, it's resulting in more recommendations to investigate some of those soil gas issues.
And Jay, one more thing too is, you know, there's so much going on with these environmental issues in the SBA. I just find that keeping up with it, A, and B, is just having these conversations up front with the borrower and saying, look, phase twos are much more prevalent than they used to be. And if you don't have all of your records in line, no matter what industry, you're going to be subject to a phase two. That really does go a long way because, you know, it's one of those things where we told you, and I agree with Stephen, you know, doing a phase one is you know, whether you pay 2,000, 3,000, 4,000, whatever you're paying for, it's a really good indicator of what's going on at your site.
Yeah, I mean, there's some basic questions you can ask up front. You know, if you're doing a loan in California, there's some very good online resources to get out in front of this stuff. You could call your consultant and ask them to do a quick screening for you. But, you know, to your point, Randy, I mean, I can't tell you how many times we'll recommend a phase two and then someone will dig out an old phase two that was done, you know, 10 years ago that they didn't want to share up front. So, you know, having those conversations up front, have you ever done a phase one? Do you have prior phase twos? You send those reports to your consultant, you're just going to get that, you're going to get out in front of the issue a little sooner than you would otherwise. Questions from the audience, hopefully for the lenders, not for the consultant here that's just moderating. Nothing? Maybe I'll give Chris another chance here. Chris, I know you've told us a little bit about your product. Is there anything that we've talked about, you know, over the last hour that that really makes you stand out and your product stand out for these lenders that you didn't discuss?
Yeah, a couple of things. I think especially when you get that backtrack that can happen in deals, environmental issues, the customer changes their mind because SBA fees are hefty. The cool thing is with our software, it's just right. Maybe you lost a week or two on the deal. They change your mind. You just go back right to the platform. All the financials are still there. Everything's on the server. You can just change the format of the deal and put it back into, instead of SBA, 7A or 504, it's going to be conventional. You pick that option, let the AI do its magic again. And within minutes, right, you just, again, get now conventional options that, again, match out at 98%. So that's one thing I want to touch on, especially some of the backtracking happens. A couple of things that also differentiate us from platforms out there. With us, you get uncapped requests, meaning, you know, you don't run into a limited box, right? If you go to one bank, if you've done a few loans, sometimes they say, hey, you know, 5 million is the most we can lend. You don't run into that problem here and have to now go, okay, this bank's done, where do I go? our system's always updating guidelines. Our system's always adding new lenders. So that's another benefit with our product. And another version, again, broker access, consumer access, bank access to our platform are a couple of things I did want to say it's different than anything out there. And our funding rate, there is no lending software that has a 98% AI-based funding rate. We have that. We're a CFL licensed company, so that rate is audited every year, and we have to prove it and get tested on it, and we pass it with flying colors. And again, from a security standpoint, I know the last thing I want to touch on, we have the highest SSL encryption out there. We also use Amazon Web Server, which is, again, one of the best servers out there. I'm sure everyone knows Amazon. So from a data standpoint, that's why we have banks that trust us with their internal guidelines in our software, brokers and banks using our software as well, because we use the highest level of encryption. Our CTO is a 20-year vet that has won tons of Webby Awards, which is kind of like Oscars in their world. So from a security standpoint, you could trust us as well to take care of all these financials and data you're putting into our software.
Thank you. And let's go back to Dane. It's been a little while, Dane. You guys are hyper focused in this small business and owner user space, from what I can tell. Maybe talk about those advantages. And also, you did mention you do both 7A and 504. What about the CDCs? Can you tell the people on the panel, how these CDCs get involved in some of these programs? Let's see. Maybe we lost Dane. Does anybody else want to pick that up for Dane?
I'll pick it up. So there's about, I think there's like 12 or 13 CDCs that are in Southern California. And I know at Spectrum Commercial, and I'm positive that everybody else on this panel, it deals with all of them. So it really is two ways. We need them to do the second trust deed loan. And so we call them when we get a loan request. But it's also the opposite too. Sometimes they're calling us because they're getting referrals and they need a first trust deed lender. So there's certain CDCs that are in certain geographic areas where it makes sense. I think that probably most of us have a few favorites that we like to steer most of our loans to, but we participate with all of them. They got the same rate, same program. Most of them are very good. They're, as far as being proactive and getting it to the finish line, and being easy to deal with, and their back rooms. So yeah, it's actually it's a pleasure working with all of them.
Thank you. David, I've been on some panels with you. Seems like when we're at these live events and we open it up to questioning, you seem to field a lot of questions. We don't have any questions now, but tell us what questions you typically get. Feel free to jump in here and add anything else you want to talk about.
One of the things that I was going to kind of comment on, especially for if you're an investor that's thinking about going this route, if you're a lender that is assisting a client get over the hump on a piece of owner user property, the thing that the thing I find lacking often is that client having a good team assembled before all this starts to unfold. Typically at the very least, you've got to have somebody such as myself. Obviously, you have to have the lender. You've got to have a good broker on the buying side. You have to have a good insurance person. You definitely need to be involved with legal. These are all things that you really need to have assembled when you start this, because and the way that I approach it is you have a team if as an example, if you need to reach out to legal for a consult, that there's somebody that you're going to call that's going to pick up the phone when you call. You know, if you have to start to create a relationship with anybody, it's too late. And as we know, these deals kind of get lives of themselves that all of a sudden now, where you thought you had a lot of time at the beginning, now you have none. And the luxury of time is a great stress reducer. So definitely having all those ducks in a row are key. But also, I do believe that leveraging off of existing contacts for all these different in all these different disciplines is very easy and very possible. And I'm sure we have all, fielded a question from somebody, hey, do you know a good attorney, or do you know a good insurance person? And you got to make sure you're free to give that information out, because that's, I think, how a lot of deals get done, or not having that information is how a lot of deals get tripped up. I think the owner user area is like one of the last bastions of being able to have two significant assets in a client's portfolio and watch them both kind of expand their wealth like significantly at the same time. That's kind of like I guess what they call, that's cheating, sort of, but it's a great way to cheat. And I think each works off of each other. So having a solid team that you can rely upon, I think, is absolutely crucial.
Yeah, I think that's a great point. The teamwork makes the dream work, right? Cool. Well, we got 10 minutes left. I mean, I just like to open it up to the panelists to just throw their hat in the ring. And, if there's something they've been wanting to talk about that I have missed, then please jump in. I said, please.
All right, Jay. I guess since, we've seen a lot change and we've seen rates kind of blow out here in the last, week to rates that none of us thought we'd probably see since last year. Just some things to talk about going forward. I'd, be really careful with lenders that you're working with out there when it comes to rates, where you stand on rates. It's changing every day. Make sure you stay in front of it. Other things I would consider is, I think you're going to start seeing banks start tightening up policy a little bit until things maybe settle. So just, potentially, maybe not as optimistic as things were before. Just to be aware of it. That doesn't mean that anything's going to happen or there's going to be any changes, but just be aware of where your financials are. I mean, inflation's still, we're still seeing costs on financials for clients. This is for brokers. We're seeing costs shoot through the roof, and we haven't seen some of it yet. And, I've spoken to a few, wholesalers and manufacturers. They can't increase their price fast enough. Although they're passing it along to their clients, it's coming up fast enough. They can't keep raising the price every 2 months, and I think that's a struggle. And I think we're going to start seeing that on some of the financials. So I think the SBA product on the owner user side on the projected side is going to start becoming a great product. But just being aware of the environment that we're going into, it's going to cost a little bit more on rates. And, I think banks are just going to be a little bit more cautious. So just want to put that out there as a comment. We're aware of it. And, we will work with clients in understanding historically how they came out of COVID and where they're going in the future. And we will work with them.
Yeah, that's certainly the elephant in the room, right? This rate environment. So anybody else want to back up or add to what Peter said?
Just to add to what Peter's saying is, yes, it's a rising rate environment when we're looking at loans, especially if it happens to be a purchase that involves a business. We're backward looking. We're always looking at the last few years were the tax returns, last year's financials, the year-to-date financials. This past performance dictate what's in the future? Probably not, but it's all we have. So when we look at those numbers, and we got a rising rate environment, we're going to have a larger payment. And so all these margins are going to start getting squeezed. And to make things work, it's going to mean one of two or both things. There's going to be more cash down, or the price is going to have to come down. So I think we're going to see some changes maybe coming up in the market. Like Peter said, I think we're going to see some lenders start to tighten up, maybe require a little bit larger down payment. Some of that's also going to be driven by lenders that are maybe a little bit more fearful / overly cautious when they start. In the underwriting world, you'll hear the underwriters talk about, yeah, you calculated the cash flow, but when we stressed it, we don't have it. So there's a lot of backroom underwriting that goes on out there where there's even more interest added to what we're seeing to try to account for what's going to come down the road. So it's it's going to be interesting. I get a lot of phone calls right now, but like I always tell my customers, you never call me when it goes down. So, and it'll come down again someday.
Yeah. Thank you, Cliff. I wonder if you're a small business owner and you've had these plans to own your own building. It seems like you'd still forge ahead with that despite some of these economic issues. Do you guys agree with that, or do you think this will? I mean, obviously, it's going to make the application process maybe a little more challenging, but do you think it's going to dissuade these owners from holding off on their business plan to own their own building, or are they just going to forge ahead? Anybody have any thoughts on?
A lot of it has to do with where you're at. Still in Orange County, Los Angeles County, people they got to go somewhere, whether they're going to rent or own. And with the low inventory, these lease rates are still very high, and it makes sense. You got to look at the interest rates, of course, and stay ahead of it. I agree. But the thing is that we're kind of in a normal period, a normal interest rates. Don't forget, for years and years, it was arguably, artificially low. So it being in the 4, 5, 6s range, it's still reasonable, especially when you compare it to what lease rates are in Southern California. So yeah, I think a lot of them are still going forward there, but they're cautious. They're looking. They're thinking. Underwriters are, Cliff, like you said, it's the only thing they got is to go backwards. But I'm finding that underwriters are starting to ask, where do you think you're going to be now at the end of 2022, or where do you think you're going to be at the end of 2023? So those questions are being asked too.
Yeah, I would agree. I think the rates have been artificially low. I think it's the values of the buildings because of lack of inventory is what's driving that. So when you put the two together, it does drive up that payment that maybe they can't afford it. But to your question, Jay, I think if you have a growing business and the outlook for a certain industry is looking promising, I think space is going to be needed, and that client will continue to move forward. I think if they're a little hesitant and and they're not sure where it's going, that's where you're gonna start seeing people maybe rent smaller spaces or rent for a little bit before they buy. And I'm sure David has a lot of clients. Flamer could probably tell us quite a bit on what some of the psyche is of clients these days. But that's what I see is that comparison of whether they're gonna buy or not.
Great. You guys keep chatting amongst yourself here for these last 5 minutes. I mean, you probably have more insightful questions at this stage in the conversation than I might come up with.
Well, I think what you said, Jay, is about right, though. What'd you say? Teamwork is dream work? What'd you say? What was that that cliche? I liked it.
Teamwork makes the dream work.
Yes. I got to tell you, all this advanced planning, I hate having these conversations when they go into escrow. It's great to have it as they're looking for the property. And I think everybody would agree with that, but you don't always get it.
Yeah, well, we've got about 30 more seconds before this breakout room collapses. So just want to thank all you guys for joining and participating, and thanks for the attendees. You've got everybody's contact information here. So if any questions do come up, please reach out directly to the panelists here. And
Jay, thanks for moderating.
Yeah, thank
Yeah,
you.
you
Thank
bet.
you very much, Jay. Very good job.
yeah, my pleasure.
Hey,